Super glad to be in community with you this afternoon, along with my colleagues, Diana Siegel-Garcia and Patty Biafra, also from the Shared Ownership Center here at Nexus Community Partners, and our colleague, Mara O'Neill, who is one of our partners. We're going to talk about one of my favorite topics today, which is Finance 101. We're going to walk through some basic concepts of business today, and I'm hoping that you are excited about being on this journey with me this afternoon. We're going to talk about some basics of business, and we're going to talk about why these basics can really help you build a solid foundation for your business. And we're going to take some polls along the way, hopefully answer some of your questions that you may have, and hopefully learn some new concepts as we go. So with that, we're going to go ahead and get started this afternoon. Appreciate your time, and we're so glad that you're with us. So we want to start with an introduction of our team here at Nexus. So many of us are on the call, but just a quick introduction for our team. Benjamin Tsai is our director of the Shared Ownership Center here at the Shared Ownership Center. You've met me. I'm Christina Nicholson. I'm the Cooperative Developer at the Shared Ownership Center. Diana Siegel-Garcia is our Program Manager. Patty Biafra is our Director of the Worker Owner Initiative here at the Shared Ownership Center at Nexus. We're going to talk a little bit about today's agenda. And we're going to start with introductions. We're going to talk a little bit about how numbers tell your story in your business. We're going to do an overview of financial management. We're going to talk about how to read a financial profit and loss statement. We're going to talk about understanding budget to actuals. We're going to do an analysis of a cash flow statement. We're going to do balance sheet basics for you. And then we're going to talk a little bit about our program, the Local Fund. We'll do a high-level question and answer period. Then we'll talk to you about some upcoming webinars we also have scheduled for the rest of May going into June. So for introductions today in the chat, we're hoping you can just share your name, your preferred pronouns if you prefer, and we just wanted to see if you have any particular questions, either about cooperatives or general business planning that you were hoping that we might be able to answer or cover in today's webinar. We'll be happy to take a look. If we can answer them as part of the overall webinar today, we're happy to do that. Otherwise, we'll do our best to, if we don't cover the material, answer your questions at the end of the presentation today. So if you have a question, please, after you introduce yourself in the chat, go ahead and drop those questions in as well. We're glad you're here. So we're going to start today with a really general statement. We know that most of us have a narrative about why we start our businesses, why we're in business, and budgeting or planning for your business is not just telling your dream out loud. Budgeting and numbers is another way to tell the story of your business. And so budgeting is not just for people who don't have enough money. Budgeting is for everyone who wants to make sure that their money is enough. And that's really one of the key elements that we're going to focus on today. So we've done some trainings already as part of this webinar series. And if you're interested in those webinars, they're up on YouTube, and we'll provide a link for those at the end of the webinar. So as we've learned in some of those previous trainings, a solid financial plan can help you plan out a vision for where you see your business going. It's based not just on your mission and vision, but the needs that you're meeting with your business, the community and clients that you serve, the deliverables that you want to provide, the volume you want to provide them at what speed you want to grow your business. So today's training is meant to help you understand how to create the basic building blocks of your business, or as we're calling it, Finance 101. So what does financial management help you understand? Some of the key elements that we're hoping you'll understand after today's training are how to know if you're making a profit in your business, how to decide what you can afford to buy or to spend, how you can plan for overall growth and new markets for your business, how you can plan for the future and adjust course. So we have a question that we hope you can answer in the chat. Can you give us an example of when you have used financial management? So to distill what we're going to present today even further, we're going to talk about four basic elements. We're going to talk about profit and loss, also known as income statements. We're going to talk about how to evaluate budget to actuals. We're going to talk about cash flow, and we're going to talk about balance sheets. And so we're going to focus on these four specific areas that are key building blocks to understand the basic business analysis and decision-making that people use when they're developing their business plans. These four kinds of data sets provide answers to the questions that every business owner needs to answer, including how much revenue did a business make in a specific period of time? Did we make the amount of money that we said we would make? How much debt do we generate and how much debt do we have to pay off? Was the amount of debt more or less than what we planned for? How much cash do we have available? Was it more or less cash than we planned for? What are our net assets? How much cash do we have on hand? For most of us, at some point in our lives, these questions can be simple guesses. Becoming a business owner means that we need practical tools to help make these numbers real and a way to monitor changes to these resources over time. These tools or documents are universal tools that help us achieve the goal of truly understanding what these numbers actually are. So what is a profit and loss statement and what does it tell you? A profit and loss statement tells you the financial history of your business. It measures if your business is profitable, comparing your revenue and your expenses over a period of time. And it is a great tool to determine the financial health of your business overall. A profit and loss statement gives you a strong picture of your business. It tells you not only where you've been, how your business has performed, but also how well your business is doing. It is the first document that most lenders ask for when they want to evaluate the overall health and performance of your business. So the first thing we're going to do today is we're actually going to look at a real life profit and loss statement. So for a sample profit and loss statement, the first thing that most people look at is what's called the total income or the revenue of a profit and loss statement. Revenue can come from a wide range of sources, all the services that a particular business performs. In this case, this is a landscaping business, and so they have both a retail element and a wholesale element in the form of landscaping services. The next place that people look at is called the total COGS, also known as the cost of goods. This is the cost of raw materials. So this is what is paid out in order to acquire the materials that this business needs in order to generate revenue. After that, you have what's called the gross profit. So the gross profit is what is left after they pay for their wholesale cost or their raw material costs. Next are their total expense costs. This total expense cost is what it costs to do business. In other words, what it costs to pay the employees, to pay all of their bank service charges, their utilities, their rent, and all the other fees that go along with running a business. After you pay those total expenses, you have what's known as your net ordinary income. Oops. This net ordinary income is what most people think of when they think of as profit. And so frequently, that's where the bottom line stops. However, in many profit and loss statements, there's also additional miscellaneous income. Frequently, that miscellaneous income can come in the form of one-time amounts of money that you may receive if someone pays you back, for example, a loan, a one-time loan, and you get that money back. Any other miscellaneous income needs to be tracked somewhere on your profit and loss statement. So this other area allows for any one-time revenue that you may receive that you generally won't receive regularly over a period of time. Once you account for that individual other miscellaneous income, you come to your net income. After you pay all of your bills, that net income is actually how much money your business has made. And that's how you read a profit and loss statement. You start with your very top revenue, you subtract all of your expenses, and that net income is actually the cash that you have after everything else has been paid. All right. So one of the things that my clients frequently get confused about is this idea of cost of goods sold and gross profit. So I wanted to take just a moment and talk a little bit about that. Basic formula for how to arrive at net profit is this. You take your sales, also known as revenue, you subtract your cost of goods sold, then you have your gross profit, you subtract your overhead. Overhead is a term that gets used really commonly in business. All overhead is what it costs for you to run your business. That's your utilities, it's what you pay your employees. It's a term that gets thrown around a lot, but people aren't always familiar with it unless they're in the business world. So I like this slide because it tells you a little bit more what that term means. After you subtract your cost of goods and your overhead, you arrive at your net profit. Cost of goods sold is something that's frequently used in companies with inventory. An example of that might be that you're familiar with. Large companies like Amazon, for example, have a huge amount of inventory. Grocery stores, hardware stores, stores where they have products on shelves that they have to sell. All the products that sit on the shelves are inventory. When that inventory comes in the back door, they're paying a wholesale cost for it. Then they add additional cost to that wholesale price, and that additional cost is supposed to cover all of their overhead expenses. In addition to that, they put on an additional amount so that they arrive to have some dollar that is their net profit. So these terms that you hear, gross profit, overhead, net profit, this is all in relationship to the distance between what their top line revenue is and what they're going to realize as a net profit at the end of the day. So really this slide is just meant to help you guys think a little bit more about some of these terms that get used in the industry a lot. Hopefully that helps. So again, we've talked a little bit about this, but just to break it down once more, cost of goods sold can be any of these different realms. Cost intrinsically linked to offering a service or product, such as an hour of service, raw materials, or the packaging for a product. Overhead expenses include day-to-day expenses, so marketing, rent, bank fees, if you have an accountant paying them. These are things that are not the product themselves, but things associated with getting the product on the shelf or getting the product out the door. So those are the differences. All right. So now let's move into a very general overview of how this breaks out. You have your income, you have your cost of and expenses, which include materials, labor, operating expenses, and then you have one more item on here, which is depreciation. Depreciation is one of these terms that a lot of people hear, but they don't really understand. And just because we have a little time today, we're going to talk a little bit about depreciation. So now that we've talked about cost and expense and the summaries that we've seen on the last slide, including COGS, labor, and operating expenses, let's talk about depreciation. Depreciation is what's known as a non-cash expense. What does that mean? And how does it work? Briefly, we know that when an item is purchased, in this example, let's say a computer, as it gets used over time, it loses its value. So for example, we know a computer that you bought 10 years ago is not as fast or as functional as a computer that you would purchase today. So depreciation is the process of acknowledging on paper that a computer that you bought today won't be as valuable in the future as it is today. So instead of subtracting the full value of the computer, also known as an asset, all at once, you subtract or depreciate a portion of the value of the computer, again, an asset, over a period of time. But because you've already paid for the computer, you don't have to worry about continuing to track the payment of the item. You're tracking the remaining value of the item. So think if you were to resell the item, i.e. the current value of the asset. So what remains is the net value of that asset. So, for example, if you bought a computer last year for $1,000 and you were going to depreciate it over 10 years, after 1 year, you would depreciate $100 of that net asset. And so you would still have a $900 computer, right? So you're saying after a year, you sold it, you would only get $900 for it, which is the computer you bought last year for $1,000. So depreciation is a way of acknowledging on paper that even though you have this asset, this computer you paid $1,000 for last year, this year it's only worth $900. So even though it still has some value, it doesn't have as much value this year as it did last year. So it's a trick of finance to some degree, but it also acknowledges that if you were to liquidate, or in other words, sell out everything that you had available, it would still have some amount of value. So depreciation is something that you do on paper, but again, one of the things that we try and do here at the Shared Ownership Center is decode some of the language that you see in finance. So we thought it was worth spending a moment to talk a little bit about depreciation. So again, after you look at costs and expenses, you arrive at your net income. And in this formula, you start with income. After you subtract your costs and expenses of $450,000, you arrive at a net income of $50,000. All right, let's keep moving. So the last thing I want to talk about on profit and loss before we keep moving is trend analysis. As we mentioned at the top of the training, one of the things that profit and loss statements can tell you how you are performing over time. And this particular trend analysis, what you see over time is that you see your trends from October to November. In this analysis, that you see an increase in sales, and so this trend goes up. You see an increase in your sales. You also see that your payroll also increased. So while you have an increase in sales, you also have an increase in payroll. You have an increase in your cost of supplies. You have an increase in your utility costs. So while you did have an increase in sales, you'll note that your net profit from October to November actually decreased. This is one of the interesting things about trends. When people only look at their top line numbers, in this instance, sales, while it is true that their sales increased, the actual net profit or their cash, their bottom line decreased. So don't be fooled that just because your sales have increased, that your profit has increased. So that's why you need to pay attention not only to your increase in revenue, you need to pay attention to your bottom line, also known as your net profit. So that's why trends are important. All right, let's keep moving. So now we're going to talk about budgets. And Deanna, I think we have a poll question.
Did it work?
Yeah.
Okay, great.
Have you ever written a budget for your business before? Okay, well, that's great. We have some that have and some that haven't, which is perfect. That's exactly the audience I'm looking for. So let's take a look at this. So here's why budgets matter and why they're valuable. So an overview of budgets. A budget is a plan for the future, and what it's based on is your profit and loss, or if you've never written a budget and it's your first time, you can look at industry benchmarks. So if you're a new business and you're writing a budget for the first time, you want to look at what other businesses that are similar to your business have done for a sample budget. So just because you haven't done it before doesn't mean there aren't resources out there. What that is commonly called is a comp or a comparison. And so libraries, small business centers, they can help you come up with comps to help you understand what you want to use as a baseline budget or target numbers for you to start your budgeting process. When you write a budget, you use it to compare what you plan to do with what you actually end up doing. So oftentimes you'll have the same categories as your profit and loss statement, but instead of looking backwards, it projects these categories into the future. And then afterwards, when you write your budget, it's best to compare the budget to the actuals. So it tests your assumptions and it helps you improve your plan going forward. All right, so again, a budget is a tool. It helps you provide revenue goals. It helps you plan for expenses. It helps you create accountability. So for example, if you are a business owner and you hire a manager, you can set limits on what they're going to spend in certain categories. So they can only spend $2,000 on supplies because that's the budget you give them, for example. And it also gives you a plan work for framing and allows you to adjust as you're going forward. All right, so let's take a look. So why compare budget to actuals? Actuals give you up-to-date information on how well the business is achieving its financial goals. If the revenue is down or the expenses are high, it allows you to make adjustments. And in the long term, actuals tell you how realistic the budget was. A budget's your best guess or estimate. Your actuals are what are called the receipts, right? So it means that it is what you actually spent for the items or categories that you have listed. A couple of things to note: that everyone on your team, not just you as the owner, needs to be clear on what those categories are so that the receipts go into the right categories. As you become a larger company, when you work with a bookkeeper or an accountant, you'll learn more about coding your expenses so that they match what's called your chart of account. Your chart of account, think of them as the addresses for your various expenses. So your categories, as they become more layered and more sophisticated, will each be tracked in those right buckets, right? So let's say you run a coffee shop. Maybe at the beginning, you only have a cup of coffee and a latte. Maybe in a year, you have coffee, lattes, hot chocolate, and mochas, right? So you've gone from 2 categories to 4. And so when someone says, I have a coffee receipt, you need to make sure that what they mean is a cup of coffee and not a mocha, right? So you need to make sure that those receipts are matching up with the kind of drink that they made. That's what we mean by receipts, and making sure that they go in the right category. So I want to give you an example of budget to actuals. A budget is your guess. An actual is the real number. So we wanted you to see what we mean between the two. So in this example, the good news is, again, that the budget for sales was $10,000. And in this example, this team actually beat their sales numbers by $2,000. That's fantastic. Congratulations. The challenge is that they expected to spend $5,000 on payroll, and their actual payroll was 60% higher at $8,000. They thought they were going to spend $2,000. Let's stick with the coffee shop on paper cups. They ended up spending $3,000 on paper cups instead. They thought utilities were going to cost $500, but instead they had a huge water leak in the basement and they didn't know it. So they ended up spending $3,000 on utilities instead. So again, the same thing happened. Even though their sales were $2,000 higher than what they budgeted, they ended up losing $2,000 instead of making a net profit. Because while their sales were higher than what they budgeted for, their expenses were much higher than what they budgeted for. So don't be fooled. Just because your sales are higher than what you planned for, controlling your expenses is just as important as growing your sales. I would argue frequently controlling your expenses might be even more important than growing your sales. So this is definitely something to pay attention to. So let's get into something a little more complicated. This is a budget to actual that has another column that you may be familiar with called a variance. A budget to actual with variance gives you more information. A variance simply means the difference between these two columns. It can be positive or negative, and it doesn't necessarily mean that it is good or bad. It simply means that it is different than what was planned. So in this example, instead of being negative, it shows the difference between what was actually achieved or realized in every category. You may know this, but a variance can be either positive. So here, for example, the sales for this model were higher than what was budgeted. So it was budgeted at 320,000, sales were 329. So this is an overage. Sales were higher. But for this model, they were budgeted at 237, came in at 208, so they were under. So when things are in brackets, it means a negative number. When things aren't in brackets, it's a positive number. So one of the questions I had for you is, what item in this column had the greatest variance? So when you look at all of these numbers, the question is, what number had the greatest variance, meaning the largest difference between what was budgeted and the actual? So when you look at this column, you will see that the largest number in this column is this number, the electro revolving. And so the largest variance here is this 43,750. The line that had the least variance, so again, what is the smallest number in this column? When you look at that, it's factory overhead. So the smallest variance is this 456. But the most important question when you look at this entire document is, was there, between budgeted and actual, did this business actually see an operating profit? So was there a positive operating income for this budget to actual in 2014?
We have one yes in the chat.
And you are correct. The answer is yes. So even though there was a variance of $51,000, so you see a parentheses here, there is still a positive operating income. It is lower than what they planned for, but they still have a positive operating income. So you are correct. Good. I'm glad you guys are still with me and I didn't scare you away. Well done. Thank you for playing. All right. So what happens when you miss your budget numbers? So just a couple of things to share. Here are some things that this information tells us. Again, this is just a recap of what we just said. So the operating income was budgeted to be higher than what was actually realized. The variance was 51,537, below what was expected. But again, they realized a net profit. So this is just a different way, in a more detailed setting to show the difference between the two. So the answer was correct. Well done. All right. Well, if you thought these numbers were tiny, wait until you see what I have to show you next. We're going to get into cash flow, my favorite. So we're going to talk about cash flow, and Deanna has done a lovely job of showing us the fantastic moving. So why would you bother doing a cash flow projection? This is one of the most important lessons for people to learn. And it is because a business can be profitable and still run out of cash. So a cash flow projection is the balance of cash received less or minus the amount of cash paid out over a period of time. It is how cash is moved in and out of a business. A cash flow projection is a financial statement that tries to show how cash is expected to flow in and out of a business over a future period of time. It is used to see if projected receipts, or your revenue, will be enough to cover your projected expenses, again, over a period of time. So if you thought those numbers were tiny, let's take a look at these. So I'm going to walk you through this cash flow statement, and we're going to look at a number of elements. The first thing I want you all to take a look at is the very top. This is your starting cash balance. When you're doing a cash flow statement, you're going to be doing a cash flow over a period of time. So for this example, you're doing it for 3 months. At the top of your cash flow will always be your starting cash balance for whatever period of time you're looking at. So here are some things to note. The top line is the amount of cash that each month is starting with, or their starting cash balance. Then the cash is tracked from sales in the cash, or for most businesses, frequently your credit card sales that are reconciled daily can also be tracked in this category, as well as any other cash from operations. So for example, if you had frequent pop-up events that turned into cash regularly, those might also be tracked in this cash category. So any sales of current assets could be the sale of a current item. So anything, let's say that you had a cash register you didn't need, and so the sale of a current asset, that could be something that you sold off on Facebook Marketplace and you got cash for. So that could be in this category as well. So this is all the cash that you received in the month of January. So after you've realized all the cash that you have generated in the month of January, then you get into your expenditures. Expenditures is just another way to say expenses. So then you look at all of the expenses, and those are everything that you have to pay. So expenditures, expenses from operations, we talked about that in your profit and loss statement. So those are staff that you have to pay. Your utilities, bill payments are right here. Anything that you have to cover in terms of expenses, items spent on operations, those are all listed here as spent on operations. So that's all the cash that went out of the door. So you'll also notice that there was additional cash, that there was additional cash spent for repayment of current borrowing, long-term liabilities, and your subtotal of cash spent. So your total cash spent for the month was $4,626. So after you subtract what you spent from what you made, your ending net cash flow, or cash spent subtracted from cash received, was $2,393, leaving you with an ending cash balance of $5,796 for the month, which is what you bring to your top line in February. And Deanna brought in a duck question, which I think is lovely and charming. So it's our second poll question. How many times a month do you check your bank account balance? 1 to 2 times a month, 3 to 5 times a month, more than 5 times a month. All right, these are folks that are paying attention to your money. So here's why we asked this poll question. A lot of times people, when they think about their business and they think about doing a cash flow sheet, it seems kind of overwhelming. But we tie it out with checking your checking account balance, because checking your bank statement balance or checking your checking account balance, that is where you in your personal life are watching money flow in and out of your account. Your paycheck goes in, you know that you have bills coming out, your rent, your utilities, maybe you borrowed some money from your cousin that you have to pay back. So you're watching those monies flow out of your check or your bank account every month as well. Think about that at a higher level. This is what you're doing for your business as well. So we do these activities in our lives all the time. This is just taking it to that next level where you're thinking about how to do it for your business. So we are doing these things. This is just a way to take it to that next level. So let's look at February, because lots of exciting things happen in February. So February, we already know how we got to this top line. We already know about generating cash from the business. But here you'll notice in February, an investor infused this business with a $15,000 investment. This can happen for your business. You may have been talking to an investor. You may have gotten a small line of credit from a bank. This can happen for your business. So this is how you would record it, as an infusion of cash into your business. And so you track that investment, and now you have a significant amount of cash in your business. You will also notice down here that you had your regular monthly expenses. Oops. And you'll see here that you also purchased a large asset. So maybe you got that investment because you knew you were going to have to buy a piece of equipment, right? If you're running a coffee shop, maybe you needed to buy a new register, maybe you needed to buy a new espresso machine. So you got that line of credit from the bank because you knew you were going to have to buy a piece of equipment. So you generated income, you got an investment or a line of credit, and you spent a significant amount of money this month. So you spent more cash, you also had net cash flow, and you continued to have a positive cash balance. March comes along, you have cash on the top line. You'll notice here that you generated some revenue, but you had less cash than you had even in January. So this was a slower month for you. You still had your regular expenditures, you still had to pay off some debt. You had a negative cash flow for the month of March, but because you had that investment from the previous month, you'd been monitoring your cash in January and February, even though you had a net negative cash flow for the month of March, you still had a positive ending cash balance for March. So this is why paying attention to cash flow month over month matters. Even when you have a bad month, you can still plan ahead for that by making sure that you have a plan in place to manage the ins and outs and ups and downs of business, right? Many businesses have slow seasons. Many businesses have equipment needs. Many businesses have changes in labor, either increases or decreases depending on seasonality. So that's why cash flow matters. All right. Any questions before we continue? Okay. Well, let's take one more cash flow example that's slightly less rosy, and then we'll keep moving. All right. So this is a larger example of a cash flow. We won't spend a lot of time on it, but I wanted to walk you through what happens when things can slip just slightly when it comes to planning. So the first thing that you all will already be familiar with, based on the last cash flow analysis we did, is what's called total cash in. So as we looked at on that last cash flow statement, This is the cash that MA generated each month. This is the similar to the cash flow statement we just looked at. You'll see the same thing. Cash at the start of each month is at the top, and you'll see this one goes January through July. This is the cash that was generated in each month. Similar to the last one we looked at, a good consistent revenue was made for the first 5 months, but then you'll note in the last 2 months, the monthly revenue decreased slightly. Then you'll see down here in the expense category, insurance came up and ads came out. So while these expenses are consistent, so the inventory was controlled, rent was consistent every month, the wages were consistent every month, this insurance of $1,200 was either annual or semi-annual, meaning every 6 months. And so right in January, this business took a $1,200 hit. And there was also a $200 ad expense here and another $280 ad expense here that was not shown in any other part of their planning. There was also an unusual miscellaneous $600 expense in March. So then what happened as you go further down is that the cash out changed every month. So while the cash in was pretty consistent, slight decrease here, you had some expenses that were uneven in this area, and the cash out over time changed month over month, so that by the time you get down here, cash at the end of the month, by the time they hit June, they had negative cash flow. So the reason that cash flow matters is because when you have unusual expenses you don't plan for, and you have changes in the amount of revenue that you're generating every month, this is the kind of situation you can avoid because you understand these targets that you have to hit for revenue in order to manage the cash that you need to have to cover your expenses. So this is why it matters. All right, any questions before we continue? Terrific. Okay, the last section we're going to talk about today is the balance sheet. The balance sheet can be a little bit confusing, but it's also the best part because it's actually an equation, and this is the equation. So a balance sheet is a snapshot of your business's financial status at a particular point in time. So the equation is that your assets, the things you own, equal the things you owe plus the assets you have remaining after you subtract what you owe. So let's take a look at a balance sheet. Here's BAT. This is just a signifier to say that your assets are not the same as profit. So a good reminder. So this is a little wordy, but I do think that it's worth it to spend a little time on this. We're going to talk a little bit about balance sheet definitions. I'm going to walk you through these briefly, but the main thing that I want you to keep in mind is that there are different kinds of assets and liabilities. There are both current assets and current liabilities. Think of current as anything that happens within a calendar year. This will make more sense when we look at the next slide. So this recording is going to be available in a couple of weeks. You can hang on to this. Mainly, I want you to have this information available because when you first look at a balance sheet, it can be confusing. So as I walk you through the next slide, you can reference these balance sheet definitions when I talk about them on the next slide. So current assets. Okay. So Deanna's got another poll question for us. And the question is, are the balance sheet terms new concepts for you? So have you heard of the term current asset or current liability before, or even equity? So yes, we've got folks that are familiar with it, and we've got one person that doesn't. Again, perfect. This is exactly why we do this workshop. Thank you for that. So we'll talk briefly about it. I'm going to show you the actual balance sheet that we're going to look at today, and we'll talk about it in that context because I think it will be helpful for the learners that are on the call, and for the folks that are already familiar with them, I think it'll help it go a little more quickly. All right, so this is a fairly classic balance sheet. So a balance sheet, you'll notice, has two sides. This is the asset side. This is the liability and equity side. You'll notice that the side that has assets on it has a current asset section and a long-term section. So current assets, the easiest way to remember current assets is it's anything that can be turned into cash in 1 year or less. So cash exists as cash, it's liquid. When people talk about liquidity, what they're actually talking about is cash. So short-term investments, these are things that can be turned into cash in the next 365 days. Accounts receivable, those are accounts where people owe you money. So again, they're going to be paying you back in the next year. Inventory, these are things on your shelf that you're going to sell. And typically, if you have inventory, you're likely going to sell through it more than once in less than a year. So inventory is considered a current asset. Prepaid insurance, it means that that is insurance you've already paid out and it has a cash value. So that cash value is considered a current asset. Long-term investments, these are things that would be more difficult to turn into cash in the next year. Property, plant, and equipment, your land, building and equipment, those are things that it may take you longer than a year to turn into cash. So for example, if you're going to try and sell a large piece of equipment, you may not be able to turn it into cash in less than a year. Accumulated depreciation, the other reason that I spent some time wearing out depreciation on that other slide is because, again, this is a non-cash item, but it still has value on your balance sheet. One of the other items I wanted to talk about is intangible assets. Goodwill is also another way of saying your reputation. So if you were to sell Nike, for example, or you were to sell Bumble, or you were to sell another company that has a high brand name recognition, goodwill or brand name recognition, while it doesn't necessarily have a price tag attached to it, people may pay a higher price for that company because people associate specific value with that brand name or with that company. And that is an intangible asset. That reputation or that brand value, while intangible, increases the value of that company. And so that is considered an intangible asset. Other assets are receivable from an employee. Typically, that's a loan from an employee. So that gives you your total assets. On the other side of the equation are your liabilities. Similarly, your current liabilities are bills that you are going to pay in the next year. Your account payable is the bills that you owe right now. Salaries are what you owe employees. Same with interest, same with your taxes. Current portion of note. For most of us, if we have a mortgage, for example, or we owe money on a car, most of us don't have money in the bank to pay off that car or that mortgage all at once. And so we have a mortgage or we have a car note that's going to take us multiple years to pay off. This current portion is the amount that we're going to pay off in the next year. And so you may have a 20-year mortgage or you may have a 5-year car note. Whatever you're going to pay in the next year is considered the current portion of that. The rest of that debt is rolled up into your notes payable for the long term. So you also have a bank loan, your mortgage obligation, And then deferred income taxes is what you're going to owe for the long term. That gives you your total liabilities. Here's where the equation part comes in. If you were to subtract your total liabilities from your total assets, what is left is your equity. So when we say assets equals your liability plus your equity also equals your assets minus your liability. The whole point of your balance sheet is that the two sides have to balance. That's what gives you a balance sheet. It's pretty interesting. What do balance sheets tell you, and why do people care? When people look at balance sheets, here's a couple of things that they're looking at. They want to see how much cash you have. That's an interesting thing for people to know. They also want to see what is the amount of liability you have, how much of it are you going to pay off in the next year, and then what are your long-term liabilities. They also want to understand how much equity you have and what is the relationship between these three. If you don't have very much cash, but you have a lot of long-term liability, that's an interesting piece of information for a lender to know. So these are some of the things that lenders pay attention to. And as a business owner, you may not have a balance sheet day one of your business, but over time, these are the kinds of documents that you want to be familiar with. So we wanted to make sure that today you had at least a passing familiarity with this document and you understood how it worked. All right, so before we talk about the local fund, I just wanted to see if you have any questions about any of the documents we talked about today: balance sheet, cash flow, budget to actual, profit and loss. Any questions that we can answer today about any of these documents? All right. Well, we want to talk a little bit about why we're here and how we arrived here. We at the Shared Ownership Center are part of the local fund. So the local fund is a joint venture between us here at Nexus Community Partners Shared Ownership Center and the city of St. Paul. The local fund is a fund that is meant to help create worker-owned cooperatives here in the city of St. Paul. And if you are interested in learning more about the local fund, we have an eligibility form that you can fill out. We do both startup cooperatives in St. Paul and transition cooperatives for existing businesses who are interested in transitioning to worker-owned cooperatives, and we would love to tell you more. So please fill out that inquiry form if you're interested in finding out more about the cooperative development work we're doing in St. Paul. And this webinar series is part of an 8-part series that we're doing to increase business acumen and encourage folks to learn more about businesses and cooperatives specifically. We just want everyone to feel like they can be part of the cooperative and business ecosystem here in the Twin Cities. And we really want people to see themselves not only as active participants in the ecosystem, but active participants in growing businesses here in St. Paul. So here is our business planning webinar series. We just are finishing Finance 101. The next one is conversion basics. So for conversions, we're talking about cooperative conversions. So existing businesses converting to worker-owned cooperatives. That one's coming up on May 22nd. It's a really interesting process and a really interesting conversation. So if you know any business owners or your business owner, or you work somewhere and you would like to share the concept with the business owner that you work for, please join us. Same time, 3 to 4:30 on May 22nd. It'll be really interesting and we would love to have you join us for that one. So write in your calendar. We would love to see you there. And that wraps up our webinar for this afternoon. We're really glad to have you here, and we're so grateful to have the opportunity to share this information and this training with you all. It means the world to us to have you here. So thank you so much. Any last wrap-up questions or anything before we end the conversation today? All right. Well, on behalf of myself and the rest of my colleagues at the Shared Ownership Center, I just want to thank you for being here. Thank you for participating, and thank you for participating in the polls. And we're grateful to have you, and we hope we see you at one of our upcoming webinars as part of the series, and glad to have you. So thank you again, and have a wonderful afternoon. Take care.